Welcome to the InvestFourMore Real Estate Podcast. My name is Mark Ferguson, and I am your host. I'm a house flipper. I flip 10 to 15 houses a year. I own 13 rental properties with a goal to buy 100 by 2023. I'm also a real estate agent. I've been licensed since '01. I run a team of 9. We sell close to 200 houses a year. So on this show, we like to interview house flippers, landlords, and the best real estate agents in the business. So stay tuned for some great shows. If you want more information on my rentals, on the numbers, how I buy properties, check out InvestFourMore.com. Hey everyone, it's Mark Ferguson with InvestFourMore, and welcome to another episode of the InvestFourMore Real Estate Podcast. Today, I have a great guest for the show, Hunter Thompson, who is in the self-storage business. And he's also with Cash Flow Connections. And Hunter is going to tell us how he got into real estate, tell us about self-storage units and why they're a good investment. I'm excited to talk to him because we have not had a guest on before that was in this niche in real estate, and I haven't really written about it either. So Hunter, thank you so much for being on the show. How are you?
I'm great, Mark. It's an honor to be here. Definitely excited to get in this conversation today.
Thanks. Yep, me too. So let's start from the beginning. How did you first get into real estate and what drew you into the business?
Yeah, sure. So, for a lot of people, I think that 2008 was a massive paradigm shift. And whether or not you're in real estate or not, I think that was kind of a huge moment from an economic standpoint or otherwise. So for me, when 2008 happened, I had not really considered pursuing real estate. And I didn't even pursue it at that time. I just knew that there was going to be some opportunity in the investment space just because asset prices had collapsed really across the board. So I started really looking at stocks. I started looking at bonds. I started looking at trading on a daily basis. And it didn't really occur to me that real estate was the vehicle that was going to be able to kind of best take advantage of that situation until 2010 or so. And the reason I say this is as I was kind of interested in stocks and I was following the stock market on a daily basis, in 2010 or 2009, this is when the European debt crisis really started taking hold. And that's the moment that I really realized that this entire game of stocks is incredibly correlated. It's incredibly intermingled. And it's very challenging to really have an edge when the capital markets are this integrated with one another. So I remember specifically watching CNBC, and they were talking about the Greece bond yields. And they were saying if the Greece bond yield remained below 7%, then the S&P 500 was going to be fine. But if it went above 7%, then the S&P 500 was going to collapse. And I remember watching this, and I would wake up every morning in California, so in market time, waking up pretty early to watch the Greece bond yields. And, I remember thinking, how is it even the case that the Greece bond yields have anything to do with my financial well-being, let alone playing a pivotal role in the type of volatility that I'm experiencing on a daily basis? And so this really led me down the route of real estate for a lot of reasons, many of which I'm sure your listeners are familiar with. But at the end of the day, investing in hard assets that provide cash flow that you're able to leverage relatively inexpensively, the predictability of the cash flow is really the main thing. And that's kind of my introduction into real estate as a whole.
No, that's great. And I used to invest in the stock market a little bit. I thought I knew what I was doing when the market went up, but you realize when the market goes down, you don't know as much as you think you do. And the same thing for me is just there's so many things going on. You just have to be involved in it nonstop every day. But at the same time, there's thousands of other people doing the same thing. And it's crazy, the involvement, the technology, the information in the market. And that's why I went to real estate as well. What were you doing at that time? Did you have a corporate job or your own business? What was how were you making money?
Yeah, so I had a series of kind of small businesses and entrepreneur type of stuff since I was, in high school. I had a event production company. I also was a professional poker player, which is the reason I moved out to LA in the first place, actually, which is interesting. I was playing online at the time, and I had this calling to kind of pursue it professionally because I had a couple of profitable months right in a row. And I knew that the largest poker room in the world was the Commerce Casino. It may still be the case, I'm not sure. But the reason for that is that it's the laws are such in California that you have to only play skill games. You can't play against the house. So the Commerce is actually the largest poker room. And I was like, that must be the place I should go. But I moved out to California, fell in love with California, fell out of love of poker because there's a significant difference in lifestyle design from playing online whenever you want and playing live. Imagine, no disrespect for anyone that's listening that does this, but from my opinion, one of the worst day jobs you could have with some of the worst coworkers you can have.
No, I used to play poker. I don't, just leisurely, not anywhere close to professional. And I actually met a pro poker player at a conference too who was into real estate. I forgot his name, but you watch the World Series and you see kind of the highlights of like, oh, it's so exciting, but you don't realize they're grinding it out for like 12 hours a day for 2 weeks to get to that point. It's like, oh man, that must be miserable.
Exactly. I've played some 24-hour sessions in my day. Those days are long over, but that's definitely been a reality in the past.
All right. So
I had, a small event production company, and then real estate was kind of my first, moving all the chips in, to use the metaphor, because of just the opportunity there. And because of the fact that, there's kind of a crossover with poker, because of the fact that you're looking at everything on a risk adjusted basis, which is something we'll definitely talk about later. And, with real estate, you can find very clear risk adjusted returns and risk adjusted rewards pretty easily if you know where to look.
No, that's an interesting metaphor. I never thought about that. But with poker, for those who don't know how to, don't play poker, like odds are everything. It's a numbers game, figuring out the odds. May not win it in the short run, but in the long run over time, if you play the odds right, you're usually a pretty good poker. And that's kind of how real estate is as well. So that's pretty cool. So yeah, how did you, first get your first real estate investment or get started in it?
Yeah, absolutely. So the first investments I made were actually in performing mortgage notes. I mean, you talk about risk adjusted returns. Back then, you could get really solid, low teen returns for just lending money to people that were flipping houses. And so we were lending money at 60% loan to value in really non-volatile markets for people to buy foreclosed properties and fix them up. So I'm talking, 60% loan to value, 13% interest rates, a flat monthly interest rate in a market like Memphis, Tennessee, where the property value may be worth $100,000, we'd loan $60,000. In the event that they fail to make those mortgage payments, we'd foreclose and take the property back. And we took zero back. There was zero notice of defaults filed. I mean, it was just incredible. It's basically like buying a CD that just happened to pay 13%. So obviously those rates have significantly changed since then, but those were kind of the first introductions I made at the time. And, in my opinion, those were kind of no-brainers back then.
Yeah, and you're right. The lending has changed so much for flippers, where it used to be 12 to 16% was the norm, and now it's dropped significantly. Is that why you got out of that business and did something else, or was it another reason that got you into? I'm not sure if it's self-storage next or something different.
Yeah, so I started to see a lot of opportunity in the passive syndicated model, and that's my favorite investment vehicle. So essentially, this is when you syndicate or pool investors together and have a sponsor who is kind of overseeing the entirety of the investment. Commercial real estate provides a unique situation where you can invest, minimums of, let's say, $25,000 or $50,000 into a syndicate, which will then invest in turn into a property that may be worth $5, $10, $15 million. But the key for me is that you're able to rely on experienced operators that have hundreds of millions of dollars of transactions, and they're very much incentivized to perform. But the key is that their experience level is such that, we've worked with operators where I would have to spend the next 10 years of my life exclusively focusing on one asset class to be half as good as they are. So if they are even taking half of the gains, I'm still ahead because the time component just simply isn't there and the ability for me to diversify. So I was looking at multifamily, retail, office pretty early on. And again, back in 2011, 12, there was a lot of opportunities in those traditional asset classes. I think that I started to notice in 2013 and 14, particularly in multifamily, again, looking for risk adjusted returns, it became very challenging to find those type of returns in those traditional asset classes. And that's what really led me to self-storage and mobile home parks later, looking for those niche recession resistant type of investments that are going to perform during all stages of the cycle.
Yeah, I've heard that from a lot of people. I heard from some giant hedge funds that all they do is buy apartment buildings, and they've said, we can't find apartment buildings to buy right now. because prices are so high. There's so much
Right.
money going into them. I know there's deals out there, there's off-market stuff, but the environment has gotten much tougher to get into multifamily than it was a few years ago, that's for sure.
Exactly. And again, you mentioned the hedge funds. The reason for that is that there's purchase prices that are large enough to attract those type of players. So, kind of segueing into the self-storage asset class, that's one of the reasons I really like the space. The purchase prices are not that much in terms of if you have $200 million to allocate to self-storage, it's going to take you years if you're doing it, without just completely closing your eyes and buying everything there is. So, staying away from the really competitive asset classes, I think is key, especially in this economic cycle, in this economic climate where we are in the current cycle.
So what was the first self-storage unit that you bought? Was that something that you controlled? You were the investor, or did you invest into it and there's another operator?
Yeah, so I typically invest passively into syndications. So I'm what's considered a full-time passive investor, and I know that sounds like it may not make sense, but the nature of my business is to help investors invest in passive syndicates. So I spend my time doing due diligence on the operators, doing due diligence on asset classes, identifying a best-in-class operator in a particular asset class, and then leveraging their expertise. So the first self-storage investment I ever made was in Fayetteville, North Carolina. And that's a property that, we may talk about the details a little bit later on the call. But again, it had all the makings of a solid self-storage investment. It was in a market that has a military base, which those tenants tend to make great tenants because usually military deployments are actually longer than the average tenant stay. So that's kind of a key market tell there. The property was a little bit under occupied in terms of market conditions, and we just saw an opportunity there to go in, raise rents, and more effectively run the property, and it's turned out quite well for us and the rest of the investors as well.
Very cool. But what kind of returns do you typically see when you're investing passively into these projects?
Yeah, so I'd say that it depends. It depends on the overall strategy. So kind of to kind of paint some color as to the returns, I'd say that there's two major strategies in self-storage, in my opinion, currently. So the most, taking on a lot of risk, you can do development. Now, I don't think it's necessarily necessary to take on the risk to do development because of the tremendous return possibilities that there are in looking at value add self-storage. And so when I say value add, I'm talking about buying properties that are significantly under market rents, underperforming, undercapitalized, and taking advantage of the fact that there are already tenants in place providing cash flow, and then simply adding value to the property. And there's a lot of different ways to do this. So a lot of people think of self-storage as kind of a really passive and simplistic asset class, but the reality is there's a tremendous amount of complexities that can be included in the asset class if you run it like a fully functioning business. So best in class operators are going to look for things like SEO, marketing. They're going to talk about building relationships with nearby businesses, truck rental companies, for example. I mean, U-Haul alone is a tremendous strategy. So one of the things we do is we will look at a property that is, let's say, $3, $5, $7 million that doesn't have a U-Haul component. We'll buy the property based on in-place income and then immediately call our contact at U-Haul, have those trucks parked on our facility for zero capital expenditure, rent those trucks out to the tenant base, and take a commission for facilitating the transaction. Well, that line item can add up to $4,000 directly to the bottom line on a monthly basis. So we may, to answer your question about returns, we may look at a property that may look or appear like a 4 cap or a 5 cap, but we buy the property based on in-place income, implement that strategy alone, and you look at $3,500 a month or so times 12 divided by a 7 cap, you're talking about at least $500,000 in value added. So once you're able to add those strategies and increase that income, you're seeing the cash flow go from 5% up to 8% to 9% to, let's say, 13 or so percent by year 8, 9, 10. I think that'll kind of give you an accurate idea of the cash flow there with that strategy.
Very cool. No, that's really interesting. Like I said, I know very little about self-storage myself, and the whole U-Haul component, that's really cool. Like I'm sure most people never think about that, but there's got to be so many different things you can do with self-storage. Like you said, to increase rents, increase occupancy, just like a multifamily property where you're doing a value add there. It's kind of the same thing with the self-storage.
Exactly. And it's just a tremendous amount of mismanagement out there. I think 77% of all the self-storage in the United States are owned by independent owners, which means non-REITs. So many of these independent owners, they're mom and pop operators that only have one facility. So they simply don't have the systems in place to effectively operate the entire facility. You see that with U-Haul, you see that with, branded merchandise sales, for example. When you're able to sell branded merchandise, you're able to get your brand, your logo out into the community, which increases brand awareness and therefore increases foot traffic to your property. And you're just not seeing that if you only have one property, because what's the point of really creating brand awareness if that's your only property? So you're able to purchase that property with tenants in place and kind of implement those strategies quickly. And then you kind of compound that with the fact that the tenant base is relatively non-sticky, or they're relatively sticky because they're not price sensitive, as the gross dollars doesn't really affect them, even if you're really aggressive with your rental increases. So for example, if you were renting a property, or let's say there's one unit that's $100 a month, if you increase rents by 6%, which is pretty aggressive when you compare it to something like multifamily, for example, that's only $6 a month. So the question becomes, is this tenant going to take the time to take the day off work, hire a rental truck, get movers, move down the street, where they're probably going to do the same thing anyway, just for $6 a month? And, we have found overwhelmingly that the answer is no. So they make for great long-term investments. You're able to consistently raise rents by $6 or $9 a month. And, cash flow becomes quite lucrative.
Yeah, no, I could see that for sure, because like you said, you're talking about such a small monthly amount. And I have storage units myself for my flipping business, where we have units full of supplies. And I even bought a shop this summer to put all that stuff in. And I haven't had the time, my contractors haven't had the time to move it yet. So even though I have a space for it and I'm paying monthly fees for my storage unit, it's still there. So I know how much of a pain it is for other people who don't have the space, who have all this stuff. It's not easy to just vacate your storage unit.
Exactly.
Okay, so now this might be completely off topic and something you know nothing about, but my wife and I used to watch Storage Wars all the time. Do you ever get involved in like the repossessing of units, or have you seen it happen, or that aspect of the business?
Yeah, it's a good question. And I'd say that a lot of those things that go on, like the things you see on TV, a lot of that has to do with mismanagement. So if you're having a lot of repossessions, evictions, etc., it's because of the fact that you have a tenant base that is used to not paying on time or not paying at all. So what we want to do is we want to find properties where that's kind of the standard, buy those properties based on in-place income, and then implement more effective marketing strategies, more effective management strategies. So at the beginning, things can be kind of rough. There can be some evictions. There can be some, we can lock or we can cut locks on doors. It's not the overall strategy. Like, for example, in the Excel sheet, we don't even have a line item for like the proceeds of resold items because that's not part of the business. But the key, though, is that the laws for repossessing or handling evictions or doing late fees, it's much more favorable in self-storage than it is in any other asset class that I'm investing in. The reason for this is just that the laws happen to be more favorable because people aren't supposed to be living there. So courts have found that if you need to be paying 30 days later, you can be evicted. It's not you, right? It's supposed to be your belongings. So that's kind of an interesting answer to your question, but definitely it comes up. And it's usually more favorable for us than it is for the tenants.
No, that's actually my next question was, how much easier is it to evict people than, say an apartment building where, depending on what state you're in, it might take, 60 days to 6 months in some places to evict someone. Where
definitely.
And you don't have to have the sheriff come. Well, I doubt you have to have the sheriff come and go through all the hoopla of doing a tenant eviction when you're doing these types of things.
Yes, that's totally correct. And obviously each state is going to have different laws, but on a national basis and by state basis, you're going to find that the litigation process, that whole eviction situation, is much more favorable for self-storage owners than it is for multifamily owners, for example, or single family investors.
No, very, very good information. And that is interesting how that business works What about like supply and demand for storage units? I'm sure that goes into your, when you're looking at an investment or a town. How important is that when you're looking at these different projects?
Yeah, that's a really great question. And I have an ebook that kind of touches on this topic that I'll make sure to link to so your listeners can take a look at some of the data that we have. But, since the mid 90s, the asset class basically doubled in size. So it went from about 20,000 facilities to about 52,000 facilities as of right now. Now, to put that in perspective, that is more than all of the Subways, Starbucks, and McDonald's combined, which is insane. Now, the reason for this is that it makes a great investment vehicle, and also the consumer base really likes it. But the key here is that while this was happening, occupancy rates remained relatively high, above 77% or so, and rental rates were actually increasing during that time when the asset class was essentially doubling. So the thing you got to be careful about, though, because it makes so much sense from an investment perspective, they're popping up all over the place. So you have to look in markets that are still undersupplied, which there are plenty of. One of the ways we look at this is about the national average is about 7.8 square foot per person on a city by city basis. So what we're looking for is markets that have significantly less square foot per person than that. So we'll start with 7 square feet per person, and look at that and kind of multiply that number out within a 5-mile radius and see how undersupplied or oversupplied the market is. So if we find that a market has 150,000 square feet undersupplied based on the national average, that may be a good market for us to look in, because let's say the average facility is 50,000 to 100,000 square feet. Even if a brand new 2018 development comes online right next door, it still will be undersupplied, meaning that we can aggressively raise rents per the earlier discussion. So hopefully that'll kind of give you a good idea there. There's still markets out there that are undersupplied and where self-storage makes a lot of sense.
No, that helps a lot, because I know in my town, I'm in Greeley, Colorado, which is north of Denver, about 50 miles. I know of 2 brand new projects that just opened up. And there's been other brand new projects opening up over the last few years. And to me, I'm just like, holy cow, there's a lot of self-storage going on now. I have no idea what the square foot per person is here. But no, that's good to know how you're looking at different markets and making sure that there's demand there still for the actual units. What about during the housing crisis when the real estate markets were going down? What happened to the storage unit business?
Yeah, it's a really good question. This is really my interest in the space from a big picture perspective to begin with. So the key is that people use this product when they're going through some kind of lifestyle change or life change in general. And a lot of these changes can be brought on by recessions. So you think about job changes, foreclosures, layoffs, downsizing, kids moving home from college unexpectedly, things like that. Those are really common during recessions. And those are really good reasons why people end up being tenants of self-storage facilities. So you kind of have this balancing factor when the demand for the product actually increases during recessions, but let's say income levels in the capital markets are kind of contracting. Well, the Self-Storage Almanac puts out data on this information, and we have found that in both 2001 and 2008, the rental rates and occupancy levels were relatively unaffected during the recession because of the fact that the product caters towards these changes. So when recessions happen, people are more likely to go through those problems, whether it be foreclosures or having layoffs, et cetera, which cause them to move cities. And therefore, it kind of balances out that whole act of what's going on in the overall economy when things are contracting.
No, that's interesting information. I was wondering if that would be the case because, like you said, people are maybe downsizing or moving in with family where they need those storage units and do not have the space anymore.
And, just to add something to that, because I think there's a really important conversation to be had about, the other side of the coin. So in real estate, and this is just my perspective, but I think it's, it's important to take into consideration, the demand for the product is going to be really a great way of pinpointing whether or not the cash flow will be stable. But that doesn't paint the whole perspective, right? Because this whole what really causes problems in real estate, I'd say 99% of the real horror stories in real estate doesn't have to do with demand. It has to do with the loans, the liability of taking on a lot of leverage. So when investing in these weird niche real estate investments, like self-storage, for example, you have to be careful with your leverage because the demand's going to be there. That's not something we're typically worried about. But if there is a refinance that's coming due, a loan is coming due and needs to be repaid in the middle of a economic correction, the first thing to go usually are these niche transactions. Banks say, look, we're loaning on A-class multifamily only. We don't want to loan on self-storage. And you can see how that kind of conversation could be had, particularly in the last recession in 2008. So we want to make sure that the loan to value and the debt service coverage ratio is appropriate enough and conservative enough to weather those storms. And some of the ways that we do that are implementing those value add strategies, like U-Haul, for example. Mandatory tenant insurance is another one where the cash flow is increasing significantly. So the debt service coverage ratio is paid for. And also when you're doing that, you're adding value to the property, meaning that in the event that there needs to be a refinance, we're like, look, we only needed to have a 55% loan to value. Shoot us that. We'll be able to repay the loan. Our debt service coverage ratio is good. No one's in a position to complain. We think that that's kind of better positioning ourselves for the future, at least.
No, that's a great point to bring up and something I hadn't thought of. But because, during the last housing crisis, I mean, commercial lending almost dried up completely for a while. So there's a lot of worry and, like, oh my God, are we going to have like, a million commercial foreclosures going on? But luckily things pulled through. But yes, that's a great point to bring up about that.
Yeah, it's something interesting. And it's really, that's where the real mistakes can be made in real estate. I think that, especially looking at that data, people are going to rent the product. People are going to rent single family, but you got to be careful about your leverage or you can have some serious issues with principal reduction.
Right, for sure. So let's say someone decides to invest in one of these projects or becomes, part of the syndication. How long does the investment typically last? Are they, there for 5 years, 10 years? And then how does that whole investment work?
Yeah, we typically utilize a 7 to 10 year time horizon. I think that that is a good number to be conservative. I think that when sponsors are putting together deals, they think about being conservative, and sometimes you forget to consider time as one of those ones that is really important to a lot of investors. So we think that time, in terms of 7 to 10 years, that is enough time to buy a property, implement a value add strategy, raise rents, raise occupancy levels, decrease expenses, increase efficiencies essentially, and then sell during favorable market timing. And that last part is really important, but we have basically no control over that last part. So the key is that we want to give ourselves enough time to be able to weather an economic storm, and in the capital markets, I mean, particularly, and then sell. And then part of that, again, that has to do with the loan as well. You want to be able to get loan terms which are long enough to help you weather the storm so you can sell during favorable market timing. But 7 to 10 years is typical for what we're looking at.
Okay. No, very good to hear. And I imagine just parking your money in there forever is not the best utilization of that cash. You really make a lot of money adding value, selling, kind of recycling that money over and over again.
Definitely. And then, some of the arguments can be made, it's difficult to raise capital with an infinite time horizon. But at the same time, there's a lot of family offices out there that have been able to buy properties, implement value add strategies, and refinance basically infinitely. I was on site in Denver, actually, looking at a property that the sponsor was in for about $600,000, and they had pulled out $2 million. And they had the property since the mid 90s, and they're not planning on selling anytime soon because the tax basis is massive. So, I think when investors think about time horizons, what they really care about is when are they going to get their money back? They don't really care about when they're going to sell the property. If you can do both at the same time, that's definitely something to take a look at.
No, that's sounds like there's multiple ways to make money in the business, to get in, get out, or hold for the long term. I mean, are there anything else, that people need to be worried about investing in this type of business? You talked about the markets oversaturation, the economy, financing. Anything else that you really need to take a look at?
Yeah, and part of this is just my strategy, and it's definitely a gut feel perspective. It's a personality check. I always prefer the passive strategy because I want to spend time doing the things that I'm good at and the things that I have expertise in. And I'd say that also, I want to, more importantly, I'm willing to give up control for diversification. My entire portfolio is built around the concept that I want to be able to sleep at night. And one of the ways that I achieve that is being as diversified as possible. So in order to achieve that, I am willing to give up some of the control over the assets in order to invest passively, defer to someone else's expertise. This is especially important in an asset class like self-storage, where the complexities and the way in which those complexities are implemented is the entire important piece of the investment strategy. So if you're thinking about doing this, definitely at least consider going the passive route, because going the active route, you basically have to have your entire business built on those efficiencies. And I have found that, lucrative returns, especially on a risk-adjusted basis, can be found in the passive investment strategy.
No, great information. I don't know if you mind telling us this or not, but how many different projects do you invest in across the country?
Yeah, so I'm currently invested about 30 syndications in many different asset classes. In terms of self-storage, we just closed. I got an email this morning saying we closed our 7th. We've invested in 7 since 2013. And again, I think that this is one of the few asset classes I'm seeing consistent opportunities on, at least on a quarterly basis. You mentioned multifamily earlier. That's one of my favorite. I love investing in multifamily. The math makes sense, and it's a product that people love. But you have to be, right now, especially in my opinion, with my deal flow, I'm not seeing a ton of opportunity. I am seeing a lot of self-storage facilities out there that do not have U-Haul or do not have mandatory tenant insurance, or simply not effectively running the facility. So that's where my business is set up and my portfolio is focused right now.
Oh, great information, and very cool to see how many different things you're invested in and the pros and cons of each of them. I think that's all I had, Hunter, for my questions. What's the best way for people to contact you if they want to learn more about this or get that free book you were talking about?
Yeah, absolutely. So you can go to the website, cashflowconnections.com, and sign up and create an account there, and I'll definitely reach out to you. Also, you can send me an email at any time, Hunter Thompson at cashflowconnections.com. And if you send me an email, say that you heard me speak on the show, I'd be happy to send you a free ebook. And it takes about 45 minutes to read, but I think you'll get a good idea as to why I think the asset class is really primed for success over the next 10 years or so.
Very cool. Well, no, you opened my eyes to a lot of different things about the business, and you kind of have perceptions about different investment classes. And I saw all these storage units being built around me, and you automatically think, oh, that must not be a very good business. Well, from my perspective, some people might think it's an awesome business to see everyone building it, but I always wonder about oversaturation. But you brought some good insight onto the value add and different things. Anything else you want to add before we head out of here?
No, I just want to thank you again. I mean, I know that, the information that we're talking about today, I mean, this is stuff that both you and I have learned through people that, have transacted millions and millions of dollars of transactions. So essentially the podcast you're putting out is worth millions. So I can't thank you enough for putting out a free podcast on the topic. I know your listeners really appreciate it as well.
Well, no, thank you so much for being on. And yeah, great information. I appreciate you sharing, what you're doing personally, as well as the pros and cons of doing these projects. And no, I think I learned a lot, and hopefully our listeners did as well. So thank you again. And I really appreciate it.
Thanks a lot.